Thanks to everyone for joining us today. I'm Adam Newman. I'm a partner and senior wealth advisor with the firm, and I'm joined by Lowell Pratt, our president and a key member of the investment team. As most of you know, we did hold a similar webinar last week, but we felt it would be timely to touch base with everyone again, given the events of the past few weeks and into the last month, and especially in response to a lot of the questions we're continuing to receive and that our advisors are receiving from clients. So we've collected some, what I think are some fantastic questions for today. We're prepared to address most of them. And so just as a way to start things off, I'm going to pass things over to Lowell for some opening comments, and then we'll get to your questions.
Thank you, Adam, and thank you everyone else for joining us today. Part of stock market investing is dealing with panics. We're in the midst of an historic one, and it's important to understand what's happening now and what to expect ahead. In my 35 years in this business and with Bernie, this is currently the third largest panic. And VIX is a good measure of this. So the trigger for panics is pretty much always the same. There is going to be some uncertainty that's related to an underlying root problem. That's exactly where we are today. Panics end after there's been a final capitulation, maybe yesterday's sell-off, maybe not. The root problem becomes reasonably understood and defined, and there's a credible solution to the root problem and its implementation. This is the reason why stocks rise during recessions. So this is a long-term chart of VIX over the 35 years that I've been in this business. As you can see, the VIX spike that's into the mid-70s as we speak is a historic one. To put this into perspective, the peak VIX reading after 9/11 was just under 50. So to get a VIX reading of 77, I think is around where our peak was, is comparable to what we experienced back in 2008. There was an almost 90-point reading back then, and then it was almost 100, and this chart's not showing it, but there was an intraday reading of almost 180 points in VIX back in the crash of '87. So what I want to do is look at the stock market responses to these panics, both in the moment and then over the long run for these three historic panics. So in 1987, we had a steadily rising market. We had basically an order imbalance related to algorithmic trading. Program trading is what it was called back in that day. The single biggest daily sell-off occurred in October 19th, 1987. This is the biggest panic by a wide margin that I've ever experienced firsthand. And it felt like the world was coming to an end. If you advance the clock, this is what it looks like 5 years after that panic has subsided. So pull ahead, and basically what this is an enormous amount of uncertainty in the moment. There was that final capitulation on the 19th, and then there was a belief that we had an understanding of the problem and a credible solution, and obviously a full market recovery, and then the market advancing beyond to new highs. So this is 2008. This was a longer occurring panic. It took a long time to reach the bottom, but again, we had a peak reading here of almost 90 when we got to the end. And we had the same exact conditions, a lot of uncertainty over this whole period of time in terms of what the economic effects, of sort of our speculative excesses of that period, what they were going to look like. There was that final capitulation. There was a credible resolution and plan put in place, and then again, advance the clock. And we see a nice, pretty sharp rise, and eventually the market going on to new highs. So if you look at where we are today, we're at that point, or at least near that point of maximum uncertainty and full-blown panic, as evidenced by our VIX readings, in the mid-70s at present. No, I'm sorry, go back briefly. So what we don't know at this point is where the bottom of this is. It maybe has already occurred. It maybe has not already occurred. but the conditions for that recovery in the market are the same as I mentioned before. There has to be a final capitulation, there has to be an understanding and a definition of the root problem, and there has to be a credible plan to address those in place. And once that occurs, then we should expect a recovery as we witnessed in those earlier two mass panic events. So let's shift gears to try to understand what exactly it is that we're dealing with. I'm sure, like many of you, I've been spending a lot of time trying to understand the nature of this problem, just how big a risk it is, and what we should expect, both from a personal standpoint in terms of how this might impact our health, but then also from an economic standpoint and what this will look like with our investments. So currently, and there's basically three key vital stats related to viruses and epidemics. So one key stat is the fatality rate. Currently, it's reading about 3%. But that number's inflated because the number of infected people is much higher than those officially diagnosed. Most estimates that I've come across have believed that the fatality rate for COVID-19 is going to be in the neighborhood of 1%. Now, the next part of this is how contagious is this? There's two factors that are related to that. There's a natural reproduction rate. It's estimated that COVID-19 is about 2.3, and that's basically an indication of how many people will become infected by each infected person. The only way for an epidemic to end is for that reproduction rate to drop below 1. And then the final key element here is the serial rate, which is the amount of time for one infection to lead to another. For COVID-19, that's about 4 days. So now I want to compare these numbers to other virus epidemics that we've recently faced. So again, those numbers that I just shared for COVID-19 are the top row. Influenza, we face this every single year. You can see that from a fatality rate, it's a tenth as dangerous as COVID-19. The reproduction rate is less. And the serial rate, which is actually going to be very critical to dealing with this, is much lower. It's half the time. It's 2 days. SARS is about 10 times more dangerous in terms of fatality rate epidemic. Reproduction rate is a little bit higher, and the serial rate is 7 days. And then probably the worst one that we faced recently has been Ebola, very deadly. 50 times as deadly. The reproduction rate is 2, and the serial rate is about 14. So social distancing, which is what we've seen recently with the cancellation of all gatherings, sport events, companies implementing remote working policies, all of that is a response to COVID-19. It is the most effective response until there is a vaccine that's developed. That's probably 12 to 18 months out. And the longer the serial rate, the greater the effectiveness of social distancing. So this is fortunately longer serial rate than the flu, but it's shorter than the other two that we looked at. So this is going to make this is why COVID-19 is going to be such a challenge for us to deal with. However, China has been effectively containing COVID-19, and that is really impressive given the much higher population density. That's one of the factors working against the effectiveness of this. So there is obviously a way that we can address this pretty reasonably. Much of Europe has actually become the new hotspot, for this, and part of the reason is their reluctance to implement the social distancing policies. And what we've seen recently is very encouraging, in my view, which is a very aggressive implementation of this in the U.S. So now we'll shift to now we have some sense of what the problem is that we're dealing with. We need to think about and come up with some estimates around what this is going to look like economically. So McKinsey and Company, about a week ago, published an analysis that I'm sharing some of their findings that basically paint 3 different scenarios. The first scenario is a quick recovery, which in order to have that, you need to have a strong public health response and a limited duration of this epidemic, I think we're already past this potential scenario. If this were to occur, global GDP growth would drop just fractionally, 0.5% in the year ahead. I think this next scenario is probably a more plausible one than the first one. This involves a weaker public health response, causing a wider spread, but with the spread slowed by seasonality. So most coronavirus strains are seasonal, just like the flu, but not all of them. And it's too early to tell whether whether COVID-19 is going to have seasonality. If this is to occur, then the global GDP growth rate will drop quite a bit. It'll drop down to about 1%, but it won't move us into a global recession. Global pandemic scenario is the third one. This involves a weak public health response and no seasonality. If this were to occur, McKinsey's analysis is that we will have a recession, and there will be a global GDP shrinkage in their estimate of about -1%. So how do we respond to this? So there's obviously personal responses that are needed. Practice social distancing. It's our best defense at this point. Appropriate hygiene. It's just like you're trying to guard against the flu in terms of what you need to do in public. In terms of your investments, I think much of the damage has already occurred. We need to stay the course with our investments. I hope you all appreciate the fact that we always have a high quality bias in our portfolios that sometimes works against us on a period-to-period performance basis, but it puts us in a position where we're always well prepared to handle the inevitable storms that come. In time, our portfolios are going to fully recover. And after recovery is a very good time to revisit your asset allocation. How did you handle this full-blown panic, and are you comfortable with the prospect of facing that again with a similar asset allocation in the future? If not, then it's time for a change, but not today. That would be post-recovery. For some investors, it's a time to consider adding to equities. I'm going to personally add $500,000 to my investments today. I want to, make clear that I'm not playing market timing. I didn't raise this cash in anticipation of this kind of market hit happening. My other big personal investment area is real estate, and I was preparing for an opportunity there that I've just shifted to this opportunity in the stock market today. And as my first boss, Ted Rosenberg, some of you might remember him, would say, keep the faith. So with that, I want to turn it over to Adam, who's going to address the questions that were posed for today's town hall. Thank you.
Great, thanks, Lowell. And just as a starting point, as we tackle some of the questions, I think the final count on client questions came in, close to 150, maybe a little bit more. So a lot of anticipation leading up to this, and the way we thought was most appropriate to tackle the questions on an individual and a global basis was to narrow this down into 5 key themes concerning our clients right now. So what I'm going to do is work through each of these 5 themes, highlighting some of the individual questions that fall underneath them, and I'm going to share some additional data points along the way. So post-presentation, if you feel like you submitted maybe a little bit more of a specific question, or if your overall concerns haven't been accounted for appropriately, then what I'll advise you to do is certainly reach out to our team directly. We emphasize this every time we hold something like this, but I'll say it again. We have and have continued to build out a fairly large team of professionals for the sole reason to be available to work with you and address your questions, specific needs, and concerns. So no 2 clients on this webinar are the same. There's a lot of personal and unique elements that go into our client interactions. So especially those conversations you have with your advisor, they're very important. So let's use that as the next step if you walk away from this feeling like there might be some unsolved questions, especially in times like these. So these are the 5 key themes. Are we in a bear market? Will there be a recession? Number 2, what's being done by your team as a result of what's happening? Number 3, should I consider taking a defensive position with my portfolio? Number 4, should I be making changes to my investment allocation? And lastly, what comes next? So a few questions about the crystal ball, which we'll address as we kind of wrap up towards the end. So for the first question, are we in a bear market and will there be a recession? Lowell's hit on this a little bit already, but I'm going to use a couple of visuals while I talk through this. The technical answer to the first part of the question is yes. We did hit the definition of a bear market just the other day. So bear markets are market declines in securities falling by more than 20%, typically amid widespread negative investor sentiment and fear. So that top to bottom drop of 20% is the trigger point for what they call a bear market. Corrections typically 10%. So at the time of the last webinar we had, we were just over the correction territory. Now we've crossed over the line as it pertains to the bear market definition. So we're down about 25% or so, depending on which specific segment of the market you're looking at as of yesterday's close. So we're there. Not only are we there, but this has been the fastest move from peak to bear market territory in history, with the drop occurring in under 20 days. So not a lot of time to think here. It just kind of happened. So I've got, on the vertical axis, the percentage decline, on the horizontal axis, the number of trading days that it took for each of these various historical bear markets to occur. So we're the heavily shaded pink line there, right out in the front. You see it front running everything else, hitting that 20% trigger well before some of these others. So as Lowell said before, recessions, downturns come in all different shapes and sizes. This one in particular happened relatively quickly, just given the heightened uncertainty and the spike in panic related to the virus and the economic impact. So next, as it relates to the recession bear market conversation, we'll focus specifically on the recessionary side of things. So just like we defined a bear market, we'll define a recession really as 2 consecutive quarters of declining economic activity. So with the recent sell-off, markets are absolutely pricing in some sort of a significant decline in earnings expectations and economic activity. That's usually what the market's signaling when you see a sell-off. When there's uncertainty, it's uncertainty related to the cash flows of the companies you're invested in and their business prospects. So this sell-off signaled or triggered a serious amount of just questions. What's the economic outlook going to be at the individual company level and also at the market level? So, it certainly feels like, based on hitting that 20% decline, markets are pricing in, at the very least, an economic slowdown. So we rode into the sell-off on what we thought was pretty solid economic footing, especially with regards to the consumer and the labor market. Coming into 2020, there were expectations for earnings growth in S&P 500 companies, somewhere in the neighborhood of 7% or so. And now, if you translate that to what's happened in the S&P and the broader market, we're beginning to price in somewhat of a meaningful decline in earnings and potentially a recession. So a couple of points on that. Number one, we don't get into earnings season for another few weeks, and that's just the preliminary start of earnings season. So we've got some time, some lag time between this market reaction and then also when the data is going to pour in. So there's no meaningful way to forecast or try and quantify the actual impact until we see the hard numbers. So the market's trying to get ahead of this. Everything else and the variables around it are complete guesswork right now. Number two, we have no clue what the virus is going to do to the behavior of the public, spending at the corporate and personal level, and the shocks that it could potentially create to any systems within the economy, like the banking and the healthcare space. So we can't, under any level of circumstances, start to throw numbers or assumptions at the wall. This peak uncertainty related to this and the question marks in the different pockets of the economy and our behavior is exactly what translated to that large spike in VIX. VIX being the measure of volatility. The higher the number, the higher the uncertainty. So the VIX in its nature is trying to forecast over the next 30 rolling days, how significant are the swings going to be in the day-to-day movements in the market? So higher VIX, higher volatility, and we've seen that. So that's all related to the fact that we just don't know enough information yet. So with that, I'll state the obvious, and that the market is essentially trying to do its job and price in a recession. So the positive news, if we're going to take anything from this, is that markets are already, before the unveiling of any data, anticipating some sort of an economic slowdown, and we're likely going to get it on some level. As Lowell pointed out, those three potential scenarios, 2 and 3 being the ones that are most likely at this point, both involve a meaningful slowdown in economic activity in the short term. So there's going to be few surprises on that front, just given how sharply the market reacted. But whether that turns into an actual definable recession or not is going to depend. So we'll watch it and we'll monitor it, but at this point, it's going to be an unfolding of a lot of various pockets and situations. With that, and the reason why this becomes tricky is that the markets and the economy, they do not walk together holding hands. Just like we said in the last webinar, markets don't speak to us. They don't always communicate why they're overreacting or underreacting. The markets and the economy have a similar dynamic where they're not glued to the hip. Over long periods of time, when I say long periods of time, I'm talking in decades, there's an incredibly strong correlation between market returns and GDP growth in the U.S., but in the short term, they can deviate very quickly. So one front can typically run over the other and try and jump ahead. So the market is essentially doing wind sprints ahead of the economic data because we've got no playbook for the situation that we're in, and there's a level of panic. So this type of panic and uncertainty probably translates more to a post 9/11 kind of world than the Great Recession. So if we tried to make any kind of past comparison, what type of uncertainty are we dealing with, and what is it similar to? I would say 9/11 is probably a better benchmark than what we saw with the financial crisis. Bear markets, if we look here on this particular chart, it's all of the recessions that we've hit since the Great Depression. And what we notice is that bear markets are relatively consistent with recessions, but these bear markets come in all different shapes and sizes, as do recessions. So one thing that's consistent is we tend to anchor our perceptions and how we feel about recessions and their behavior based on the most recent one that we've experienced. So in this case, it would be the financial crisis of 2008. And this is not, we cannot make a direct translation or correlation between this situation and that situation. This is an exogenous event. This is something that's happening outside of the system. 2008 was inside the system with the failure of banks and the financial collapse of different financial services firms. This is something coming in from outside the system and causing disruption. So banks are as well capitalized as ever. We're absolutely more prepared for this. And when I say this, I mean any type of recession than we were several years ago, given the strength of the economy. So as I tie this into some of the sub-questions we received, I had a few clients ask about bankruptcies and translating this environment to what we saw in 2008. And while some companies, especially in the energy space and in some pockets of banking with a lot of exposure to energy, which has been hit hard with the oil price collapse, they're going to face some serious headwinds. But the types of companies we invest in, the financial analysis we do in terms of their financial quality and our quality bias, as Lowell pointed out, put us in a pretty good footing there in terms of avoiding major bankruptcies or bank failures. We've got a financial quality bias in the way we pick investments. So no major concerns there on our front. We're still waiting for the federal government and the Fed to take additional action. So that'll be the next wave of this whole discussion, is seeing just what are the policies at the monetary and fiscal level that'll be implemented to try and combat this. Final point on the recession bear market trade-off is the recessions, they don't happen in real time. So there's no one flying over our house with an airplane writing the recession is here in the sky. Economic data in its nature, it lags, and it has many revisions that are printed after the fact. And that's why most of the times when we learn we're in a recession, it's already happened and the markets are well on their way to a recovery. So we can't anticipate or try and forecast things, especially in this type of an environment when the data is not coming for a while and there's a lot of behavior that's going to be baked in and decision making that's baked into how that data sorts itself out. So this is absolutely not the kind of information you want to try and make an investment decisions on. So that's, I feel like, a pretty good summary related to bear markets, recessions, our thoughts around timing, the magnitude, and the economic landscape behind it. Number two is what's being done by your team as a result of the recent sell-off. So a very valid question, given that we are active managers and we've got a responsibility to identify opportunities for clients and act on them. So being well-read, researched, and prepared and understanding what's happening, there's not a strong correlation between that and taking action, especially when it's at the wrong time. So times like what we've been experiencing over the last handful of trading days, those are not the times to be selling stocks or making knee-jerk reactions. So a lot of what we're doing at this point is just stepping back, evaluating the behavior of the market, and preparing ourselves to make the appropriate adjustments, but at the appropriate time. So we think we still got a little bit of time for the dust to settle and things to sort themselves out. Clients that are checking transaction history in their accounts at the end of each really sharp down day, you're going to notice a little, if any, activity. So the markets are readjusting themselves. With that is going to come opportunity. It's going to be a function of time. To reiterate again, as we did in the last webinar, we do not make tactical moves to cash or other asset classes based on what we're hearing or reading. It's incredibly difficult to have investment success with that type of approach. So what are the things that we are doing? And I want to point out three areas or three pockets of action items that are important to communicate to everyone so that when they do see activity in their account and adjustments, they know that it's likely falling into one of these three umbrellas. The first being rebalancing. So when markets behave the way they have, our plans are moved off target. So we're going to need to look at a couple of things within rebalancing. Number one, does our balance of large cap versus small cap need to be readjusted? So as an example, small caps have sold off more significantly in the past week or so. So maybe there's an opportunity to rebalance, given that where our target is now for a large versus small cap, there might be an opportunity to rebalance and get our small cap portion of the portfolio back to target to capitalize on a strong recovery there. So that's the allocation level. Number two is at the individual holdings level. So just like different asset classes like stocks, bonds, and cash behave differently, individual equities in your portfolio are going to experience the same kind of deviation in behavior, whether that be through the sector level or the individual company level. So two types of stock level rebalancing we'll look to do is just replacing individual names in the portfolio based on our process, which we follow in good and bad markets. Some names become relatively more attractive than others, so there might be individual replacements based on that and that forecast. And the other being, there could be names that we still really like that have sold off that we'll need to rebalance additional cash into to get us back to target for the long term. Second point in terms of what we're looking to do and controlling during this type of market is really a big one, I think, and a great example of controlling what we can't control, and that's tax loss harvesting. So tax loss harvesting occurs in taxable accounts as a way to manage taxes and also opportunistically to rebalance. The great thing about holding individual equities is we do have a larger element of control in the portfolio, and we know no one likes a big tax bill when in the future we need to sell certain stocks at gains, or if we identify there's better opportunities in the future, we don't want to be constrained by trying to avoid a big tax bill. So loss harvesting is the act of selling something at a loss that we might not like anymore, or might see another opportunity that's more attractive, taking that loss, repositioning, and then having a capital loss available to offset future gains. That helps improve the after-tax return, which is ultimately what's most important, especially for those in high tax brackets. Third thing here is revisiting and discussing risk with clients. So everyone's reacting differently to the recent market distress, and your ability to stay invested is heavily impacted by this. So having a relatively quiet market for about the last decade, this is going to end up providing a great litmus test for the amount of risk you should be and are comfortable taking. So our team has a lot of tools at our disposal to help you evaluate this. You know, what's the kind of risk that I should be taking, and what's my appetite for risk. So this is the piece that's incredibly unique and personal to you, and we've got the tools to help you look at that. So a matrix I show in a couple of minutes here is going to tie that together with the planning aspect of things. Another question we've gotten a significant amount of attention from is the idea of playing defense with cash. So I'm going to start by saying, while an overwhelming majority of our clients have stayed invested through the recent decline, some investors did hit their tipping point, and they made some level of readjustments in the portfolio, typically moving from equities to cash. So there is a psychological stress to these situations. It can be very real. And so I can show you all the data in the world that proves otherwise, but there's this human element that can oftentimes prevent us from weathering the storm, you know, at different levels. And this is where it becomes different. 10% to me might mean something different to many others. 20% might look attractive, while it might look scary to another investor. So I just want to spend a couple seconds here quantifying the impact of being wrong when trying to play defense with cash, but also just know in the background of this, in the context of this, that you know, not everyone is comfortable with full equity exposure, and some people need to at some point rebalance into safer categories to smooth out the ride. So this is a chart that gets a lot of attention, especially during market volatility, but it goes back 20 years, 99 through 2018 in the S&P 500, and the average return of someone who was fully invested over that time, and then what was the impact of the portfolio if you missed the best 10, 20, 30, 40, 50 days. So we all know that missing out on the upswing is oftentimes more damaging than experiencing the ride down to begin with. But when you tie this in, the fact that economic data is lagging, markets typically recover at times when it's still most uncomfortable to invest. When we combine all those factors together, the concept of playing defense with cash becomes incredibly difficult. And we prefer to take action on the prior slide with those three things, talking about risk, rebalancing at the individual position level, and tax loss harvesting in larger taxable accounts. So a lot of data, and there's additional data behind this to really fight against the idea of trying to play defense, especially when you're already in the middle of a little bit of a market gyration, market turmoil. I'm going to close out here. This is the final matrix that I put together, highlighting what we've seen are what I think the four main levels of investor confidence and sentiment, not only leading into these types of market environments, but coming out of them, and the appropriate actions to take at each of these four levels, or four quadrants, if we want to call them. So two big questions that everyone needs to ask themselves as they're experiencing this and evaluating what they should be doing is, number one, what's my level of fear? So in the boxes at the red, you know, on the left and right at the top, we've got, if you feel like your fear level is relatively high, you'd fall under those categories. And then number two is, do you have a plan? And so there's the financial plan, which is the most comprehensive of all plans. And then there's just a general investment plan, which might be a decision to be, for example, some percentage in equities and some percentage in a safer asset class. So what's your fear level, and do you have a plan? And then what do we think are three main considerations for this type of market? What actions should you be taking? Or what are some things to think about once the dust does settle? So really take time to ask yourself, where do I land? Everyone's going to be different. So the scariest place for an investor to be is on the top right. So high level of fear, you don't have a plan. this is going to be the quadrant or the pocket where reactionary decisions are likely, where your timing is likely to be poor, and where you can do the most level of damage to your long-term financial prospects. So, for example, if you feel like you personally fall into that bucket, first step is before you take any action, as painful as it is, take the time, make a plan. You can do that directly alongside our team. Let's take a look at, what is it that we're looking to accomplish with our investments? What's the kind of risk we need to be taking? There might be a lot of positive surprises when you do that exercise and realize that you might not need to be taking as much risk as you thought you initially had to. Once you make that plan, then you can adjust your investments. We don't need to try to time good or bad markets, day of the week, good day, bad day. Make the adjustments when the plan is decided on, and then make a conscious effort to revisit that plan as things settle down. So over time, you want to really evaluate your reaction and the decisions you're making in both good and bad markets. And if you consistently do that, you'll notice that when you hit these types of periods, you feel a lot better and a lot more confident. So our clients that went through this exercise and have done a plan, are taking the right amount of risk, are absolutely in the best headspace across the board. And so this helps us gauge and understand for each of these pockets, where do we fall and what might we be able to do. Sometimes we're taking less risk than we could be taking. Sometimes we're surprised that our reactions to these types of markets aren't as significant as we initially thought. So these slides will be available. The replay will be available. Any additional questions that come up, we are here and willing and ready to help. So I wanted to keep this right under 30 minutes, and I was a little bit over, but we want to thank everyone for joining us on a Friday. And any unanswered questions, we're going to first direct you to your advisor, and then you can call our main office line. So hope everyone's doing well and that everyone has a great weekend.